Again, my name is Bill McDevitt, and I work with Chevy Chase Bank. I think in my opening remarks, there are two things that I believe banks, from a traditional lending standpoint, really owe the community, and one is access to their bank. The owner of businesses need to feel that they can access their bank through a number of channels, and the other is advocacy. And I think that one of the obligations of our banking community these days, evidenced by you all here today, is providing advocacy for small businesses, not just products and services, but understanding what the challenges you face are and how we can structure our products to bridge gaps that you might have in your growth. So I really believe by understanding what your lenders are faced with, you get a better perspective as a business owner about what you're asking for, okay? How does that sit in the minds of your lender? What forces are they under? We're not just making this stuff up so we don't have to make loans. That delinquency that was caused by the homeowner markets turns to foreclosures. Foreclosures affect the housing market, and it collapses. And collapses aggressively and quickly. It leads to bank losses. What happens with bank losses? Well, now we have a whole industry around the housing market and the peripheral businesses connected to the housing market that become really our first credit tightening target. All right. Okay, so now we're in general industries, so nobody's off the hook. Us banks are looking at all industries a little more skeptically than we were. But what does it mean to you? Let me give it to you in a little bit more clarity. We're going to ask for additional collateral. It's a fact. Again, I'm talking traditionally. We're going to be asking for a second way out of the deal, much more frequently than we would have before. The first way out of a deal, of course, is cash flow. So be prepared to put up your primary residence if you have equity in it. All right? It's just a fact of life that banks are going to want to see what you can offer as additional collateral there. Also, our rates, we're probably going to want a little bit more of a margin to offset some of the losses. It's to stay in business. It's to stay viable. Increased minimum credit scores. What used to be minimum of a 650, maybe a 700. I'm not speaking, by the way, of Chevy Chase policy. I'm talking general industry standards, so I just want to make that clarity. These are not our actual scores, but these are trends and tendencies in the market today that you need to be aware of. And I think there'll be more comments about scores and what they mean through Tim. Also, certain industries now considered too risky. We've already talked about some of those, and we can take more of those questions if you want later. But if you want to buy a building, you're going to need that 20%. We have programs, wonderful programs with the SBA with the 504. Those are still fine, but where you might be able to get into something at 10%. But if you're coming in the door and you're needing a building, the bank is going to ask for more equity, or the standard equity. In the past years, we've been able to get away with less, 85%, 90% loan to values. It's just something you shouldn't expect. Does it mean you can't find it? No, it doesn't mean that. It just means you shouldn't come in expecting that. Lastly, banks are likely to want 2 years in business. That is becoming more of a staple. The financial quality of your financial statements is probably one of the most important trends your banks are looking for now. And we've got real examples. If I have time, I'll go through one. But there are examples of fast growth, viable companies, tons of cash flow, but the growth is so fast that they didn't put the time into explaining on a CPA-prepared financial statement or a compilation how they got there. And so that growth is suspect to interpretation if it's self-reported. And a lot of times banks can't quite put the faith into it that they'd like to. And then lastly, a good business banker. You're going to find a number of them around here. And I'm not just talking about Chevy Chase Bank, folks. I'm talking about if your banker doesn't reach out to you, doesn't spend time with you, doesn't listen to you, then find another banker. Now, how do we really view your business? You guys have heard of the 5 C's. I'm going to touch on these. I don't know if you have really taken them to heart, but folks, we're back to that, okay? The 5 C's couldn't be any more strategically important today than they've been in the past. So I'm going to make this cutoff of about $50,000. Under $50,000, you're still with banks primarily in a kind of a credit card business where it's more scored They're not going to be looking at all of these aspects, but as a business owner, these are all the things you should be focusing on. A character, probably the most important, but it's a very busy category. It deals with your personal credit. Character deals with your willingness to personally guarantee the debt. If there's somebody in the room today that says my business is on its own, it runs itself, I want separation between myself as the owner and the business, you're fooling yourself because you are that business. And banks know you're that business. And if you're going to hold back on saying I shouldn't have to guarantee anything, it's just not the way it's going to work today because banks believe in you as the engine that drives that business and the revenues and the networking that you're doing. Without you, there's no business. The larger the company gets, you can maybe get into some of those waivers, but for small business, that's something to be expected. The experience and preparedness of your knowledge of the company. Know where you've been, know where you're going. You need to be able to tell your story. If you come in and you ask for additional money and you're promising growth, where is it coming from? Who is it coming from? How much profit will it deliver to your bottom line? It's not good enough just to say, I'm growing. Look what I did last year. I'm going to double that. It's not strong enough. So know your business. Know the factors that influence your ability to grow, and prove to your lender that you know your stuff. It's really, really important. We're very impressed by that. We're not impressed by 3-inch thick business plans. We're impressed by what you tell us about your business. There's a big difference between the two. It's what you know versus what you might have copied and pasted from some industry. So very important. All right, personal integrity goes without saying, right? We do what we say we're going to do. And that holds for banks as well. Capacity, another word for cash flow, your ability to generate profit. Your historical profits to a traditional lender are very important, all right? They predict. Our job as lenders is to predict what you're going to do based on what you've done. On the investment, the left side of the spectrum, it's a little different. We're going to take your word for what you say you're going to do, but we're going to charge you higher rates, higher fees, maybe even take some ownership of your business while you accomplish that. But in lending, in traditional banking, our job is to look at the historical profits and predict the ability for you to repay the debt. Okay, collateral, it's going to become more commonplace for the larger loans. If you have a home, most likely you might be asked to pledge it. But what is collateral? It's literally the assets you have that can be converted to cash. Banks are going to look to the tangible assets that can convert to cash, accounts receivable, equipment, etc. And it is something that, again, do you have to have every single one of these? Well, you probably have to have the character. But some of these other ones, are there exceptions? Of course there are exceptions among these. The message here is think about all of them when you approach your bank. Capital is the same thing as equity in your personal residence. You need to have something left in the company to say, I'm committed to this. Pulling every dime out and not showing a profit in the business might be great for you on the tax side. Again, talk to your tax attorney on your strategy. It's perfectly respectable and okay. But when you go with those same tax returns and show your bank that you don't make any money and you take it all out personally and it's over here, well, that's great, but the business doesn't show it. And equity is more than just the cash flow in the bottom line. It's the assets, the cash, the equipment that you keep in the business, minus the debt you owe against that. Okay? So it's the difference between those two, and that's a very important difference. And lastly, conditions. All right. Conditions pretty obvious. Economic factors, the business that you're in, and so forth. So we want to plug our SBA as a alternative financing resource. Go to sba.gov. Wonderful information about alternatives there. I also going to endorse D&B, allbusiness.com. These are websites that give you straight talk, and they give you alternatives, what criteria you need to meet, and a whole plethora of different options available to you. Another is Horizon Capital. I actually know this individual personally, Dave Ledwell. Go to his website. He, again, is kind of a broker that has access to a lot of niche banks for specific industries that you might find very interesting there. And merchant capital funding, I had mentioned, you can go to firstdata.com to check into those programs. Just going to